Hello friends, we are here for CA final FR revision. That is, today we are going to discuss a very small and a sweet Ind AS, that is Ind AS 34, Interim Financial Reporting. Now chartered, what does this standard deal about? As the name suggests, Interim Financial Reporting. Interim means shorter than 1 year. Interval, interim, small period. So one we have got financial reporting is done in two ways. One is annual financial reporting, one is interim financial reporting. And an annual financial reporting is for a period of 1 year. In India, we have from 1st of April to 31st of March next year. Interim financial reporting means any financial statement which is less than 1 year. So in India, you must have seen we have got in India and abroad throughout the world, there's a concept of quarterly financial statements and half-yearly financial statement. So the quarterly or the half-yearly financial statements which we prepare are known as basically interim financial statements or interim financial reporting. But the standard says any financial statement which is less than 1 year is interim. It can be quarterly, it can be half-yearly, it can be 9 months. Am I clear? Now, so you understood what is interim financial statement. Those financial statements which are prepared, or those financial reporting which is prepared for a period of less than 1 year. Now, there are two ways to prepare interim financial statement. One is known as complete set of financial statement. The other is known as condensed set of financial statement. One is complete set of financial statement and one is condensed set. Complete set of financial statements may you prepare all the financial statement, that means SPL, statement of P&L, balance sheet, cash flow statement, notes to accounts and statement showing changes in equity as per schedule 3, as per Ind AS 1 and schedule 3. Condensed financial statements means we prepare statements with few headings, few subheadings and with material notes only, matlab importance and significance note only. Few headings, few subheadings and only significance and material notes. Likewise, we can prepare only balance sheet and PL without any notes to accounts. That is also interim financial statement. That is known as condensed interim financial statement. So interim financial statements can be prepared in two ways. One is complete, one is condensed. Complete may you prepare all 5 financial statement, PL, balance sheet, cash flow, notes to accounts, statement of changes in equity as per Ind AS 1 and schedule 3, full-fledged. Condensed financial statement means we prepare financial statement with less headings, less subheadings and only with material or significant notes or no notes. Correct? For example, we prepare only P&L and balance sheet without any notes to accounts. Am I clear? Now chartered, the most important point is here. How do we decide an interim period? How do we decide an interim period? For example, we have decided that our interim period is 1/7/90 to 30th September 90. That is basically 3 months and we refer to it as Q2. Correct? And there are 3 major statements. One is balance sheet, PL and cash flow statement. Correct? Balance sheet, PL and cash flow statement. Balance sheet chartered 1/7/90 to 30th September 90. Now, as you must be knowing, balance sheet is not a period statement, is a point statement. To tell me if this is your accounting period, for example, you will understand this in a better way. Suppose your accounting year is 1/4/90 to 31st March 91. So what do you say? Balance sheet for the year ended or balance sheet as on the year ended? Sir, balance sheet as on year end. So we prepare balance sheet as on 31st of March. Do we say balance sheet is for this period? No. Balance sheet is as on. That is why in balance sheet, so what is the starting date? Some people think this is the starting date up to this point. No, balance sheet ka starting date is nowhere, right from the starting of the organization. Why? Because balance sheet represents those assets also which we would have purchased some 10 years ago. It consists of reserves and surplus which started from the day we started business. So it is not from 1/4/90 to 31st of March. This is a balance sheet date. So we prepare balance sheet as on 31st of March for all the assets and liabilities which would have accrued from the day business started till today. Am I clear? Yes, sir. Similarly chartered, when we prepare balance sheet over here, tell me you will prepare and everything is 2. 2 means 2 means current and comparative. Ha. So balance sheet current would be as on 30th of September 1990 and balance sheet of comparative would be as on 30th September 89. So don't stay it started from 1/4 to 1/7 to 30th September. No, balance sheet as on 30th September, balance sheet as on 30th September of last year. Correct? So it is of a particular date. P&L में charted again it would be current, comparative. Current is again divided into two parts. Interim period and second is year to date. And same goes over here. Interim period of previous year, year to date of previous year. That means this interim period ka is from 1/7/90 to 30th September 90. Correct? This is interim period ka. Thereafter charted year to date matlab 1 year starting to 30th September. Correct. So Q1 का 1/4 to 30th June. Q1 का for both it would be, understand this, Q1 it would be 1/4 to 30th June and year to date also would be 1/4 to 30th June. Then Q2 का would be 1/7 to 30th September, but it would be 1/4 to 30th September. Q3 का it would be 1st October to 31st December, but Q3 का it would be 1/4 to 31st December. So 3 months, 3 months, 3 months. This is 3 months. Then this is cumulative 6 months. Then this is cumulative 9 months. Am I clear? So current plus year starting to the end of current. Then again current. That means 1/4 is the base. 1/4 to 30th June. Then 1/4 to 30th September. Then 1/4 to 30th September. So this is 3, this is 6, this is 9. This is cumulative. I hope you understood. Yes, no, yes, sir. Now charted. Similarly, this same thing will prepare for the previous year. Same thing will prepare for the previous year, but it would be for 89. That is 1/7 to 30th September 89 and 1/4/89 to 30th September 89. So P&L में basically it becomes 4 3 months, year starting to interim period end, then same 2 of previous year. Correct? Interim period that is of 3 months and year starting to the end of interim period. Same 2 of previous year. Am I clear? Yes. Now charted this part ka is CFS you are supposed to prepare. That is 1/4/90 to 30th September 90. And this is 1/4/89 to 30th September 89. So this is always up to for the year to date. Am I clear? So balance sheet as on the period ending 30th September and balance sheet of the previous ending previous है comparative का. P&L में 3 months and year starting to the period ending of current year and previous year. Consolidated, cash flow statement. CFS means cash flow statement from year starting to the period ending of current year, from year starting to the period ending of the previous year. Understood? Yes or no? Yes. Now it's given. Interim period 1/7 to 30th September. So as on 30th September, as on 30th September. For interim period 1/7 to 1/4. For interim period 1/7 to 30th September, 1/4 to the 1/4 to 30th, 1/4 to 30th. Am I clear? Yes. So this is the period. These are the statements which you are supposed to prepare. Now charted. How do you recognize income and expenses, assets and liabilities in your interim financial statement? The standard says all assets, liabilities, income, expenses are recognized in interim financial statements using the same principles of annual financial statements. That means, suppose when we are preparing annual financial statements, suppose if I tell you salary is 2000 per month, correct? And I have paid 28,000 salary. Salary is 2000 per month, I have paid 28,000 as salary. So 2000 per month, full year ka how much? So 24,000. So 24,000 will come in PL. But you have paid how much? So 28. So how much excess? Sir, 4. That 4 will come in prepaid. Same principle over here. So 3 months. So per month ka salary is how much? So 2000. But you have paid 10. So 6,000 will come in PL. 4,000 will be considered prepaid. Okay. So depreciation also for 3 months? Yes. Okay. Provision? No. So tax also will calculate. Okay. So all expenses and income should be recognized in the same fashion. 3 months is your accounting period. So if you have paid for more than 3 months, it will become asset. If you have paid for less than 3 months, then it will become outstanding payable liability. If you have received for more than 3 months, then it is pre-received. If you have received for less than 3 months, it is accrued due receivable. Am I clear? Yes. Second important part. All income and expenses in whichever interim period they were incurred, it should be recognized in that period only. That means, suppose in Q2 there was a bad debt. So you will not spread that bad debt for the entire year. You will write it in Q2. You had a profit on sale of asset in Q3. So you will write profit on sale of asset in Q3 only, quarter 3 only. You will not spread it. Am I clear? Any income or expense incurred in the interim period should be recognized in that interim period only without deferment, postponement or preponement. Am I clear? Suppose you have incurred profit on sale of asset in Q3. You will not spread it in all 4 and say preponed in Q2 and postponed in Q4. No. Sir, once again, you had profit on sale of asset in Q3. You will not spread it in all the 4 equally and then say preponed for Q1, Q2, not allowed. Postponed to Q4, not allowed. It was incurred in which period? Q3. You will recognize in Q3 only. Okay. For examples, bad debt, sales promotion expense, depreciation, employee benefits, finance cost, admin, exceptional loss, exceptional profit, anything chartered. Whichever interim period they are incurred, you will record in that period only. Am I clear? So, 2 points are to be kept in mind. All assets, liabilities, income, expenditure are to be recognized following the same principles of annual financial statements. Correct? Any income earned or expenses incurred in interim period should be recognized in that interim period only. It should not be deferred or postponed or preponed. Am I clear? These expenses should be recognized in the respective interim period only in which they occurred. Correct? Yes. Now charted, very, very important thing. So, suppose sometimes a heavy sales expenditure, Q2 may you incurred selling expense and Q4 may there were heavy sales. So, sales also you will recognize in Q4 only. It may be highest like winter garments ka sale. So, Q3 you received major sales. Q3 में major sales आया. It does not mean you will spread it. Q2 में you had less sales. Q3 में more sales. Fair enough. Q2 में there were heavy sales promotion expense. So don't some people say Q3 में I did major sales expenditure, sales promotion. Q2 में I did major sales promotion activities which led to heavy sales in Q3. So this is against matching concept. No, Q2 may you incurred sales promotion expenses, recognize in Q2 only, don't try to spread it. Q3 may you had heavy sales, you recognize in Q3 only, don't try to spread it over a period of 4 quarters. Am I clear? Now charted, there is one more drama over here. That is income tax expense. Income tax expense के लिए first you need to understand it should be recognized on weighted average tax rate. It should be recognized on weighted average tax rate. Now, what is weighted average tax rate? When you are in Q1, when you are in Q1, you know profit of Q1. Can you estimate profit of Q2, Q3, Q4? Yes. So then you will say estimated annual income divide on estimated annual income tax and estimated annual income. So Q1 ka you know, Q2, Q3, Q4 you have estimated. So you got estimated annual income. Every quarter ka tax also you will be able to estimate. Yes. So estimated annual tax into 100 is equal to weighted average tax rate. Correct? But remember, when you are calculating annual tax, it is tax rate into an estimated annual income minus carry forward of losses if any. Because carry forward loss hoga, previous year mein there was a loss which you will set off in the current year. Okay. So there is Q1, Q2, Q3, Q4. Correct? Q1 ka you know, Q2, Q3, Q4 you have estimated. So this is your total estimated income. From that you subtract carry forward loss. Correct? Then you multiply by the tax rate. Correct? So this first you have to calculate weighted average tax rate. Q1, Q2, Q3, Q4. India में budget and match हो जाता है. Suppose 100 rupees, 200 rupees, 300 rupees, 400 rupees. Tax rate is 30%, 30%, 30%, 40%. Correct? So annual income is how much? इसका tax इसका 30, 60, 90, 160. So 30 plus 60, 90, 90 plus 90, 180, 180 plus 160 is 340. 340 divided by 100, 200, 300, 400, 1000 into 100. Sir, weighted average tax rate is 34%. So you will calculate Q1 ka tax, Q2 ka tax, Q3 ka tax, Q4 ka tax on the basis of 34%. Am I clear? Yes or no? Yes, sir. Understood. Now chatted. The second important point. This I have recorded recognition principles of interim financial statements. Income tax expense. Income tax expense is recognized in interim financial reporting using weighted average tax rate. Water. Water is equal to estimated annual tax, that is tax rate into estimated annual income minus carry forward losses divided by estimated annual income. Income tax for the interim period, profit or loss for the interim period into weighted average tax rate. Special points. If estimated annual tax is 0, because estimated annual income is 0, then income tax expense will be calculated on actual tax rate and not weighted average tax rate. Means what? Suppose you estimated 100 rupees, 200, 300 and negative 600. So estimated annual income will become 0. If estimated annual income is 0, estimated annual tax rate is 0. Then whatever is the tax rate, actual tax rate you will multiply, you will not calculate it weighted average tax rate. If your estimated annual income is becoming 0. Correct? Second, suppose chartered, your accounting year is a calendar year. Your accounting year is a calendar year and government follows financial year. So your accounting year and financial year are not matching. Correct? So your accounting year is a calendar year. So your Q1 Your Q1 is 1st January to 1st January 90 to 31st March 90, then 1st April 90 to 30th June 90, 1st July 90 to 30th September 90, then 1st October 90 to 31st December 90. This is your Q1, Q2, Q3. Now, so this is your Q1, this is your Q2, this is for Q3, and this is for Q4. This falls in the year 8990. This falls in the year 1991 as per government, because government is following financial year. In such cases, this you will calculate, then you will not apply weighted average tax rate. Then you will not apply weighted average tax rate. You will calculate on Q1 on the previous year ka tax rate, Q2, Q3, Q4 in the current year ka tax rate. Am I clear? Yes. So 3 things you understood. First, interim period ka tax is interim period into weighted average tax rate. How to calculate weighted average tax rate? Estimated annual tax by estimated annual income. When you are calculating estimated annual tax, you are supposed to calculate estimated annual income minus carry forward losses into tax rate. Correct? Yes or no? Yes, sir. Now chartered. Second point. If your quarters are in different years, according to government, like an example, then you will not use weighted average tax rate, you will use actual tax rate. And if your estimated annual tax is also coming to 0, estimated annual income is coming to 0, then also you will use actual tax rate. So actual tax rate is supposed to be used in 2 situations: when your estimated annual income comes to be 0, and second, your quarters are falling in different financial years. Am I clear? Yes, sir. Now chartered, suppose you have got 2 heads of income, PGBP and capital gain. India में PGBP का tax rate and capital tax rate is different. Then for normal income you will apply PGBP का tax rate, and for capital gain you will apply capital gain का tax rate. PGBP का normal tax rate is nothing but weighted average tax rate, and इसके लिए capital gain tax rate. Am I clear? Yes or no? Yes. Now chartered. Special points. If estimated annual tax is 0, because estimated annual income is 0, then income tax expense will be calculated on actual tax rate and not weighted average tax rate. Am I clear? Yes. If interim period falls in 2 financial years, suppose accounting year is calendar year, but income tax year is based on financial year. For example, this was in 8990. In such cases, income tax expense should be calculated on actual tax rate and not weighted average tax rate. If income under different heads are given in the question, income from PGBP, profit and gains of business and profession, PGBP, and income from capital gains, which are taxable at different rates, then 2 different tax rate will be used for calculating income tax expense for each interim period. For normal income, weighted average tax rate; for capital gains, applicable tax rate. Am I clear? Hence, to summarize, we understood what is interim financial reporting. Any financial reporting for less than 1 year. For full year, it is called annual report. Correct? For annual report, we follow Ind AS 1 and Schedule 3. For interim financial reporting, we follow this Ind AS. Is this Ind AS mandatory? No. But in India, it is mandatory for listed companies to file interim financial reporting, quarterly statements. Why? Because of SEBI. Correct? Now chartered, after that we decided what are the financial statement. There are two ways we can prepare interim financial statement. One is annual, sorry, one is complete, one is condensed. Complete is prepared as per Ind AS 1 and Schedule 3. But condensed is prepared with lesser number of headings and subheadings, and for example, and only material and significance notes. So lesser number of headings, lesser number of subheadings, and only with material and significance note. For example, only balance sheet and PL with no notes to accounts. Correct? Now period. Period for balance sheet, it is as on the period ending and of the period ending of the previous year, comparative के लिए. P&L में current period plus year starting to end of current period and similar these two of the previous year. Cash flow statement to year starting to period ending of current year and year starting to period ending of previous year for comparative. Tax rate should be calculated on weighted. Third important point, all assets, liabilities, income, expense should be recognized as per the principle based on annual financial statements only. That means any income, expense should be recognized in that interim period in which they occurred, irrespective of when you are making payment. Am I clear? Are you understanding? That means you are not supposed to prepone any income or expense or postpone any income or expense. You are supposed to recognize in that financial interim period in which it was occurred and not in other interim financial period. Am I clear? Thereafter, chartered income tax. Income tax of interim financial statement is calculated as profit for the interim period into weighted average tax rate. What is weighted average tax rate? Annual tax expense by estimated annual tax expense by estimated annual income. Correct? When you are calculating estimated annual tax, you are supposed to consider estimated annual income minus carry forward losses. Am I clear? You are not supposed to use weighted average annual tax rate in two situations. Situation 1, when your estimated annual income is 0, that time you use actual tax rate, or your quarters and your government tax rate are falling in different periods, then you are supposed to follow actual tax rate and not the average tax rate. Second, if you have got different set of income for which government has got different tax rate, then for example in India PGBP is taxed at the normal rate and capital gain is taxed at the capital gain rate. Then PGBP should be taxed at weighted average rate, whereas capital gain should be taxed at capital gain rate. Am I clear? That is all for your interim financial statement chartered. See you in the next video with the next standard.